BHP walks away from Anglo American as the UK mining giant refuses to accept its $49 billion takeover offer. And if you've done some online shopping lately, you may find it's taking more time to receive your parcels. We'll find out why. Hello and welcome to Business Today. I'm Mariko Oi. Our top story this morning, the Australian mining giant BHP has scrapped its $49 billion offer to buy its British rival Anglo American. Its decision came after Anglo American rejected a request to extend a deal-making deadline. BHP had been particularly attracted to the UK mining giant's copper assets, which, thanks to its mines in South America, would have given a combined company control of roughly 10% of global supply. But another sticking point was reaching an agreement on job security for more than 40,000 South African miners employed by Anglo American. In a statement, BHP CEO Mike Henry said their proposal was the most effective structure to deliver value for Anglo American shareholders. Anglo had rejected BHP's previous offers, saying they undervalue the company and its prospects. Well, speaking of deals, it's been a big week for consolidation in the energy sector. The latest development, ConocoPhillips' acquisition of Marathon Oil in a $22.5 billion deal. Erin Delmore has all the details and more on this rising trend.
Think about the early days of the pandemic. People were stuck at home, not going out, and not driving their cars. Oil prices crashed. But since then, oil prices have come back up. Oil producers are back to making bank, and they're using their cash on hand to strike some deals. Take ConocoPhillips. Its share price has nearly tripled in the last 4 years, and now it's acquiring Marathon Oil in an all-stock deal worth $22.5 billion, including debt. That'll help Conoco expand its drilling operations in New Mexico, North Dakota, and Texas, and offshore of Equatorial Guinea. In the last years, large and mid-size oil companies have been competing to buy up their smaller rivals. According to Reuters, that deal-making totaled some $250 billion last year. $60 billion of that is thanks to ExxonMobil's takeover of Pioneer Natural Resources last fall. Another $53 billion is due to Chevron's deal with Hess, which was approved earlier this week. If ConocoPhillips' latest deal is approved by Marathon Oil shareholders and by regulators, it'll be expected to close in the fourth quarter of this year.
Erin Delmore reporting there. In other news, software giant Salesforce shares plunged in extended trading, down 16%. This after the company reported weaker than expected quarterly revenue. Its outlook for the current quarter also fell short of what analysts were expecting. The weaker guidance signals less optimism in the company's artificial intelligence strategy. To the shipping industry now, because there's been growing concerns about rerouting to avoid the Suez Canal that's creating more problems and higher costs. Since last October, shipping vessels were forced to avoid the waters of Yemen after facing attacks from Iran-backed Houthi militias. But that's not all. Ports and terminals are finding it hard to cope with the schedule changes after another key shipping shortcut, the Panama Canal, restricted the number of ships that can pass through each day because of low water levels. That's been in place since last November. I spoke to industry expert Peter Turchill from S&P Global Market Intelligence about the challenges facing the industry right now.
Things were actually calming down earlier in the year, but the new twist is that demand is really picking up. And so we're seeing early restocking. We're seeing fresh momentum in the global economy. Our economists at S&P Global Market Intelligence have raised their forecasts for global growth, global GDP to growth twice this year. So we're seeing a surge of demand, which is forcing up freight rates and causing port congestion and renewing the general sense of concern over the global supply chain.
You mentioned demand picking up, and of course, we're about to enter the pre-Christmas peak season, aren't we?
Normally, the pre-Christmas peak season happens a little bit later in the year. Usually it's July, August, September. So yes, we're coming right up on it. It appears as if potentially due to risk mitigation strategies, you're seeing many companies move forward a number of their shipments which is creating a sort of a temporary surge that we're seeing right now. Another issue, Mariko, that you mentioned, the ships that are diverting around Africa, which they've been doing since September, that has actually absorbed a lot of capacity because of the longer transit times. And it's also absorbed a lot of capacity of containers themselves. And so containers are becoming scarce, and that's creating delays in companies' supply chains.
So what are the solutions here? I understand that more container carriers have been built.
So there's a lot of ships that are entering service. So the container carriers are taking delivery of approximately 40 new ships every month. So these are record amounts of deliveries. And so as the year goes on, the strong likelihood is that there will be additional capacity that will become available in the market that will force down freight rates and hopefully ease port congestion. But for the moment, we are in sort of a mini squeeze, a mini period of tightness right now that could last for a couple of more months.
With high demands, ocean carriers can impose surcharges, resulting in higher costs. So this could potentially feed into inflation if it hasn't already.
So we're absolutely seeing the impact of the tighter capacity on the market because freight rates have gone up just in the last 6 weeks or so. They've gone up about 50%, and prices across the industry are going up. So the cost of hiring a ship, if you're a shipping company, that has gone up. You're seeing very few idle ships because all of them are deployed, that kind of thing. And so what you're seeing is, at least as it stands right now, the available capacity in the system is incapable of handling this demand surge that we're in right now.
Let's turn to India now, because ratings agency S&P Global has revised its outlook on the country to positive from stable. And this, of course, comes just days ahead of the country's election results. Vinode Mukherjee explains what this all means.
Well, S&P, in its own words, said that they were doing this because of India's robust economic expansion, which had had a positive impact on the country's credit metrics. The report also said that they expect this growth momentum to carry on for at least the next 2 to 3 years. S&P added that irrespective of the election results slated to come out on the 4th of June, it expected continuity in India's economic reforms and fiscal policies. The government's increased share in spending on infrastructure has helped, said the report, which they added would ease bottlenecks to put the country on a higher growth trajectory. S&P said they could raise the ratings if India's fiscal deficit narrows. But S&P also cautioned that they could downgrade India's outlook from positive to stable once again if they see an erosion in political will in maintaining fiscal sustainability, and also if the current account deficit widens even further, which could weaken India's position.
Now, here in Southeast Asia, let's take a closer look at the surge in foreign direct investment in Vietnam. That's mainly from businesses de-risking their supply chain dependence on China and outsourcing away from the world's second biggest economy. But according to Alex Holmes of the Economist Intelligence Unit, China is back, this time as the top foreign direct investor in Vietnam and ready to do business. Here's what he said about the impact of that increased Chinese investment on Vietnam's economy.
Yes, a lot tends to get pinned on global trade tensions and de-risking from China. And that certainly is a driver and a motivation for companies to invest in Vietnam. It's close to South China's supply chains and it's a viable alternative. But Vietnam itself is an attractive FDI destination for Chinese investors. They may be looking to de-risk their own production to get around geopolitical tensions, or they may just be attracted to Vietnam as an attractive place to build things as wages continue to rise in central China.
So when you say China is now at the top of the foreign direct investor in Vietnam, what kind of changes have we seen compared to, say, 5 years ago?
Yeah, so 5 years ago, China wasn't really a large source of FDI to Vietnam at all. It's really jumped up the rankings, especially in the last couple of years. And you're seeing this, there's lots of Chinese manufacturing companies now that are looking to expand abroad into different markets. It's perhaps just a natural progression that these Chinese companies are now very competitive on a global scale and looking to move into markets beyond their own borders.
So is this about securing the labor force that are slightly more affordable than back home?
Yes, but it's also the fact that there's many factors other than labor cost these days, especially as we've had automation. Labor costs are less of an issue. Some of it is driven by de-risking. Some of it is being able to sell into those markets, as lots of the ASEAN has a young and growing population and an increasingly well-heeled middle class.
And before we go, the Australian government's cybersecurity office is working with US ticket distributor Ticketmaster after the platform was set to be hacked. The hacking group Shiny Hunters claimed it accessed the details of 560 million customers. Those details allegedly include home addresses, phone numbers, and payment card details. That is it for this edition of Business Today. I'll be back with Newsday shortly, but for now, thank you so much for watching.